From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and welcome to another episode of the Macrocast. I'm your host, Ilan Mui. I'm Managing Director at Penta, and I'm joined by our friends at Markets Policy Partners, Brendan Walsh and John Fagan. And we have another familiar voice on the pod today, John Dick of Civic Science. Hey, guys.
Good morning.
Good morning. Well, there is a lot to talk about today, including new readings on the health of the consumer and the economy, earnings, and what's going on Wall Street, of course, the Fed, as always. So let's just go ahead and dive in. And John Dick, I want to start with you because you have a handle on the pulse of the consumer like nobody else in this business. And there has been a lot of question marks around where the consumer is going. For so long, they were kind of the backbone of the economy, and post-pandemic spending was strong as they sort of worked through all that fiscal stimulus that Uncle Sam had doled out. But now it seems like maybe the consumer is getting a little more hesitant. What are you seeing?
Well, first of all, I'm not sure anybody has a real handle on the consumer right now. It's kind of you to say, but it's definitely a moving target. So we had our latest ESI reading this week. It was up slightly, which is good. That's the second consecutive reading since basically the early part of April that's been positive. Again, not anything to like uncork champagne over, but it feels like the sort of aftermath of the Silicon Valley Bank fiasco sort of has waned, and the consumer's sort of back to a slightly more confident, if tenuous, kind of view of things. Of course, that there's a number of different indicators in that index that some are up, some are down. Attitudes about the housing market are slightly improved. Job market more or less flat to down slightly. The one area that I think will continue to be somewhat dismal is confidence and intent around making major purchases like large home electronics and appliances and things. And I'm not overly alarmed by that. I mean, quite frankly, everyone bought all that stuff over the last couple of years, right? And so it's naturally going to crest. But the other thing is that the consumer is incredibly nuanced in how they're spending right now. We're seeing, trade-offs being made in category A to be able to sustain spending in category B. There are really, I don't know I think unprecedented is probably a strong word because we don't know for sure, but like prestige beauty, for example, is a category where you look at the data and it's like shocking how sort of resilient spending in that category has been. You would expect in some economic headwinds to see people trading down in categories like beauty and wellness, and they're not. They're continuing to trade up. Now that's happening at the expense of other retail categories, but it says a lot about how the consumer is being really thoughtful right now about what they're doing with their dollars. So yeah, it's an interesting time. Every day is different.
Yeah, I think that what you said about sort of the trade-offs too between are they buying major purchases or are they holding off? We're seeing that in some of the macroeconomic data as well. If you look at the personal spending numbers that were out on Friday morning, show that spending on durable goods is down, partially offset by a slight uptick in spending on services. John and Brendan, what do you make of that? How did those numbers look to you?
Yeah, it's clear as mud once again. It really is it's a mixed bag. It's like a Rorschach test, right? It's like the ink blot test. You can see whatever you want to see in there. If you're bracing for a recession, you can certainly find pockets of weakness and things that concern you. But if you're looking for resilience, there are obviously, as John Dick said, some really resilient pockets of spending like services. And this is coming through not just in the data. We'll talk a little bit more about corporate earnings, but it's coming through in management commentary as well. So when we look across the data that came out today, yesterday's GDP was a similar kind of, the headline number really didn't tell you the whole story. You look underneath the hood and there's a lot of nuance in there. And that, creates continued uncertainty, and that has translated into sort of, markets struggling to find direction. We've seen sort of the treasury yield flapping in the breeze, the dollar doing the same thing, equities, trying to get a little more upside traction, but it's sort of one step forward, two steps back sometimes, or two steps forward, one step back. It's very, very, directionally challenged.
Yeah, and
John,
in terms of market pricing, the Fed, the market thinks that the Fed will hike next week, but then it gets very, very cloudy. Not cloudy. The market thinks that the Fed's going to start cutting, and the Fed is holding strong that we're just not doing that. So the second half of the year could be very bumpy for all markets.
That's not just a market phenomenon. I mean, I think the consumers are looking for signal too.
Yeah.
One thing that's absolutely true in the 10 plus years since we started the ESI is the consumer is so much more affected by the news cycle now than they were a decade ago, simply because the 24/7 cycle and social media, and there's so much economic news out there that people are gobbling up. And it's just confusing right now. Like they're seeing those mixed signals and looking for, are things going to get better? Because if they are, I can change my spending. Or are things going to get worse? And it depends on like what time of day they scroll through Twitter or where they stop. I mean, even this morning with the PCE numbers, which obviously you're the experts. I'm not. I would go from one article to the next, and it would be, oh my gosh, inflation's not cooling. To the next one was like, yay, inflation's cooling. And so the consumer's sensing that, the experts they turn to tell them what's happening aren't even in alignment, and that's really messing up the consumer mindset right now.
Yeah, I mean, we're not in recession. Yeah, we might be, but for the last really 6 months, the sentiment in America is then we are in recession. Well, we're still creating 300,000 jobs a month.
Yeah,
One other interesting thing on the sort of the goods versus services thing, and we've been telling our particularly our retail clients this for the last couple of months, is to reorient a little bit in terms of what they think, how they define the word service. I know technically these things are considered goods, but when you look at categories like beauty and even certain categories of food service like restaurant, well, I guess that is service, but like even in a category like beauty, consumers treat that like a service. It's just a service to myself, right? It's like I'm spending, and that's why travel and concert tickets and things are still up. It's like I'm doing these things to sort of make myself feel better right now. It is a service I'm purchasing to like lift my mental and emotional wellness. And that's just a sort of a bit of like a post-COVID traumatic stress reliever, I guess, for people, but it's a new nuance in the market.
And this week we got all of the airlines reported, and they all upped guidance. They said, just the spring and summer demand is huge. People are traveling. But like you said earlier, we already bought our TVs and computers and things like that, so we're just not doing that.
Right. So, question here, maybe for the whole gang, is when we think about the trade-offs that consumers are making, are they making these trade-offs because of inflation, or are they making these trade-offs because of just where they are in their post-pandemic mindset? I mean, would we, in the absence of inflation, would we be seeing consumers make these same types of buying choices, right? Where they decide to spend their money and what they decide to trade up on and where they decide to trade down? Is this just a natural part of coming out of the pandemic?
I think the answer to all those questions is yes. I mean, it's certainly the financial constraints are impacting decision making, and what we were making those trade-offs even during COVID, even in the sort of financial windfall of the year following COVID, people were still, of course, making determinations of where they wanted to spend the most. I think what we're just seeing now is the delta between where they're going to spend the most and where they're going to spend the least is at its greatest point, right? They were trading up in 2021 without having to trade down anywhere else. Now they've got to sort of kind of work both sides of the coin in ways that they wouldn't if there weren't, economic concerns.
Got it. Brendan, you mentioned the airline earnings being, pretty upbeat and saying the demand is still going to be there through at least the summer, maybe even beyond that. What else are we hearing from the corporate sector this week? How are earnings looking, and are companies optimistic, or are we seeing those recession clouds on the horizon?
So overall, I mean, your earnings generally beat because, the companies give the guidance, so then they guide lower, and then analysts adjust it. So you're always going to beat. But there's fairly low expectations for this earnings season, and it's coming in a little better than expected. we had some, huge surprises. Microsoft 2 days ago reported very, very strong earnings. But last night, Amazon reported, and their actually overall numbers were quite good. But then the call, the CFO said that the demand for the Amazon Web Services is kind of waning. So that kind of took the markets down today. So it's been a little bit of that, one step forward, one step back. And overall, the market's just kind of flat. The big banks' earnings were quite strong. The regional bank earnings are showing a lot of constraints from they have NIM compression, their net interest margins, because they're having to pay up for deposits. But the regional banks are showing stability in their deposits, which kind of takes away that macro financial crisis risk. So overall, it's been fine, but it's not really so weak or so strong to push us one way or the other.
Yeah, one of the articles that's getting passed around this morning is citing Old Dominion Freight and Pack and a box company, basically.
Box company,
these companies that are listed companies, and you probably aren't top of mind in terms of bellwether for the economy. But think about how many things you get that are packed in boxes and sent to your front door, and it's that kind of early indicator. When you start looking, at how the consumer is going to be functioning. Obviously, Amazon sales, some of those have moved back to brick and mortar stores, but their sales were basically in the core business were flat on the year. The lower freight amounts, lower number of packing boxes being sold. And then when you cast your eye up sort of global supply chains, very often you want to look at places like Taiwan and South Korea that have those big components that are going to be coming in. And Taiwan just announced that they are the data that came out overnight showed that they are in recession. And South Korean exports have been performing very badly. And so this is the kind of stuff that you see in the macro world and say, coming soon to a theater near you. If up the supply chain is looking so bad, that may work through over the coming quarters.
If it's such a maybe coin toss right now amongst the prognosticators of whether or not the U.S. is either in recession currently or going to be heading into recession, how much could consumer sentiment tilt the scales? In other words, could we potentially talk ourselves into a recession if consumers continue to get spooked by negative headlines?
It's a classic chicken and egg question, right? I mean, the consumer is certainly taking signal from the world of media and prognosticators. And yeah, we definitely see them react to that. But it's not even just that. There's also how much did companies talk themselves into fear of a recession and start doing massive layoffs, right? And that stuff starts to trickle down as well. It definitely feels like a tipping point one way or the other is out there soon, that the consumer right now, again, is just sort of like holding pat a bit, but it wouldn't take much for them to withdraw. And yeah, that could very much have a ripple effect.
Brendan and I were talking the other day about, sort of what a recession in the back half of this year might look like. And there's the unprecedented nature of all the different cross currents in the economy suggests that, we could be going into, it's a recession, but not as we know it. It's just an untraditional kind of a recession that doesn't involve massive layoffs, right? Yeah. And involves, these continued pockets of resilience, consumers spending, making those finely balanced choices that John was referring to, and overall a slowdown, recessionary conditions, but not what we're used to. We usually see like a short, sharp shock. The recession is induced by some sort of crisis, or it hits us hard because of a pandemic or whatever it is, and then is met by forceful stimulus. This sort of seems more like we're sort of slouching into a substandard, is it a recession? Is it not? It's sort of, in this netherworld in between. And what is, and inflation, we haven't really talked about it. So you can say it's coming down, but it also sure looks sticky. and stimulus of the monetary variety and fiscal variety are just not going to be marshaled to counter a slowdown in the back half of this year. That's our expectation. Although the markets beg to differ, Fed fund futures, as Brendan said, are calling for like 2 to 3 rate cuts starting as early as September.
John,
we just don't see that.
John,
but,
I think
like the first quarter GDP numbers is probably indicative of like what's going on. It kind of showed a bit of stagflation. We only grew 1%, and inflation came in a little higher than expectations, which is the kind of the worst case scenario where the Fed stays hawkish, not necessarily raising rates, but they're not going to cut it, and we have substandard growth.
I think slouching toward recession might have to be the title of this episode of the podcast. And so much of this is obviously going to come down to the Fed, which we're going to talk about next. But first, we're going to take a short break, and we will be right back.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
And we're back with the Macrocast, and all eyes are going to be on the Fed as it meets for its regular policy setting meeting next week. John and Brendan, I know you guys have been calling for the Fed to hold or pause its rate hike campaign. Are you still behind that call, or what do you think is going to happen next week?
Yeah, it's we were out of consensus, and we're sticking with it. But the reality is the market is giving the Fed 25 basis points. Yeah, that's and essentially the Fed's probably going to take it. So we think that they probably should hold. There's a lot of as we talked about, the swirling uncertainty and just the poor visibility on the outlook, and that is. We think justification enough alongside trending lower inflation figures for the Fed to take a pause and just say, hey, we're just going to take it a month. We can raise next month if we need to. We're going to sit tight. What they could be thinking is like, there are more shoes to drop on the First Republic Bank side. That's not resolved. You've also got that, as we talked about last week, the debt ceiling. Guess what? That's going to be coming in. Probably around the time of the June meeting, and hopefully it will be resolved before the June meeting. But this is the meeting that would be, directly preceding that X date. So we think that there's enough justification for them to just take a pause. But essentially, if they hike, they're going to give themselves maximum flexibility and optionality in terms of the next move. But we are, pretty sure that they're not going to signal like a potential for cuts. That is going to be, it's only upside, right? And the market is, market sees rate cuts coming in. It's like better than a 50-50 chance priced in the September meeting. That's really close. So we don't think the Fed is going to try to fuel those expectations at all.
Yeah, you talk about the other shoes to drop, First Republic, the debt ceiling. Want to discuss both of those and maybe start with First Republic, which appears to be teetering perhaps on the brink of collapse. If you look at its latest balance sheet, I think it said that deposits have fallen 41% during the first quarter, despite the fact that it got an infusion of cash. So what's going on with First Republic? And Brendan, you said earlier that regional banks overall seem strong. So is there the hope? I guess one would hope that any problems with First Republic remain contained.
Yeah, so there's rumors that out today that the government's going to help take this thing over. But so now First Republic's problems are unique to First Republic. It's a rich person bank, and everybody. So all the good people that have their clients that brought them to First Republic are leaving. They're going to work at UBS or Morgan Stanley and taking their clients with them. So once you lose faith in the bank. When you're just a rich person bank, you're not a bank anymore. So basically, they're going to have to sell assets and just be enveloped by someone like J.P. Morgan or something like that. But the Fed would have to approve that. Obviously, I think J.P. Morgan would have bought them weeks ago, but they're not allowed to. They'd have to get approval from the FSOC. So I actually kind of think probably by the end of today, there'll be some sort of resolution with First Republic, but basically they're not a viable bank anymore. But it's not systemic. It's just kind of, they got unlucky and it's over.
If they're sort of the maybe the casualty of what happened with Silicon Valley Bank rather than the start of a new tidal wave.
Yeah, because actually the way that they got clients was they gave you a really, really low mortgage. And those are still on their books, and then they also did a bad job of balancing their balance sheet with the treasuries. So it's this kind of a similar situation, but it's not a systemic problem in the banking sector. Like PacWest, which is a kind of a similar bank in California. They reported this week, and they said that their deposits are actually rising again, and that really kind of helped rally the regional bank sector. There's an index called KRE, which is the regional bank, and that bounced this week after going down, 60-70% over the last few months.
We're also expecting some additional news from the Fed today in that it's intending to release its report or its investigation into what happened at Silicon Valley Bank. Red flags that might have been missed, attempts to correct.
I think there's like 3 hearings up on Capitol Hill next week also.
Yeah.
So this is going to be in the news.
Yeah, I mean, this is a dangerous game, but how much blame do you guys think the Fed will ultimately be willing to shoulder here for what happened?
I think the San Francisco Fed's not going to come out of this looking good.
Yeah.
So I think that's where there's going to be a lot of heat over how they, as the regulator, did that. Where they seem to be much more worried about their ESG portfolio than they were about their balance sheet. So, and ESG is a huge political, hot potatoes. So we're going to see a lot of discussion about that. But I don't know what's going to happen. But Mary Daly's the head of the San Francisco Fed. I think she's going to have a rough week next week.
Yeah, absolutely.
Yeah, Fed accountable, like holding the Fed accountable, not an easy thing to do, right? You can reputationally
when you're coming from inside the Fed, right?
yeah.
It's reputationally you can obviously do that, but there's there are not that many levers that you can apply on an institution like the Fed, whether you're on Capitol Hill or at one of the agencies or whatever. It's pretty tough to get accountability into that building.
Yeah, and the Fed here in D.C. was not in charge of regulating either one of those banks. The San Francisco Fed was in charge of it. So, you have that nuance, which, the average American isn't aware of all this stuff. But if you have to find a scapegoat, the San Francisco Fed is the scapegoat.
And you guys mentioned also that, not this meeting, but perhaps the next meeting that the Fed holds will be right in the middle of some more debt limit drama here in D.C. How do you think the Fed tries to account for that? Can it even account for that?
Well, it's a great question. We've had a lot of calls with clients too, saying like we're really worried about it, and we think you could have like a TARP moment where we actually kind of go to the brink, and then the market sells off a bunch, and then they come back. But also, if you're the Fed, I don't know what you do. You can't cut rates because you think that
But can you hike rates?
Default on their debt.
Yeah, can you hike rates if you feel like the country is ready to drive off the cliff as we talked about last week?
Well, ironically, John, like if we actually got to the brink, what's going to happen to treasuries?
Well, I mean that's what we talked about last week. That paradoxical, the U.S. full faith and credit of the United States is challenged and treasuries rally because everybody rushes to safe havens. That's probably the most likely scenario.
Yeah, you wouldn't buy the 1 month treasury, but you buy every other one.
I mean, essentially, when faced with this kind of array of risks and unknowns, the Fed's typical, unless it's right in the middle of a particular like cutting or hiking cycle or whatever it is, it just basically, should follow the Hippocratic Oath. Just do no harm, right? Wait and see, sit on its hands, hold policy for a month. What's the big deal? But this Fed is very, very freaked out about its inflation fighting credentials, even at, such a late stage of the hiking cycle. It doesn't seem to be able to, to convey messages that are more balanced, on the inflation front. They're still very much running scared, it seems, and despite some relatively better trends on the inflation data that we've seen.
Mm-hmm. And I don't know about you guys, but I was kind of surprised that Republicans were able to pass their bid to increase the debt limit and slash federal spending. I mean, it seemed like something that was going to drag on, judging by the lengthy debates they had before the bill actually made it to the floor. But once it got to the floor, it passed pretty quick. So it seems like Republicans have a stronger hand in these negotiations. I don't know what that means for the actual likelihood of an outcome of the negotiations, but you know.
At least it pushes the process forward, right?
Now we can be negotiation. Yeah. And people are kind of criticizing Biden for not negotiating, but it just doesn't make any sense, not even politically, just from a negotiation standpoint, to you let your opponent move first. So there was no negotiation until the Republicans passed a bill to begin the negotiations,
Right. So now it looks like the ball is going to be in the Senate's court. House is out until for another week or so. The Senate's going to have to act. They're saying that the debt limit bill that the Republicans passed is dead on arrival in their chamber. So the game is on. The game is certainly on.
So I was reading, so the CBO scored it. And here's kind of, to put in perspective what we're talking about. They scored Biden's budget, which is, the president presents his budget and it's pie in the sky. You throw in everything you could possibly want. Then they also scored this latest bill for the Republicans. So we know that's not going to get passed, but this is best case scenario for the Republicans. The difference per year over the next 10 years would be $160 billion, which is a rounding error in our $11 trillion budget. So we're once you take off Social Security and Medicare, there's just nothing that we spend money on. So the thought that we would actually default on our debt over what is essentially a rounding error in terms of the amount of savings that we're getting is kind of mind-boggling.
Because it's not about cutting the deficit. Neither party really cares about that. It's just politics.
Right, because it's all about how you get to that number, right? Not the actual number itself. It's just about the journey.
The
destination
totally.
is the journey.
Yeah.
Well, guys, this has been an illuminating conversation. We covered a lot of topics. We talked about the Fed meeting that's going to be happening next week. Non-farm payrolls also happening next week. Anything else on your radar screen that folks should be keeping in mind?
European Central Bank, they've got a meeting as well, day after the Fed. And, the question is whether they're going to go 50 basis points. We saw some data, the GDP data out of the EU was pretty tepid this morning. But, inflation readings that came out at the same time proved, sticky, elevated. It's not an easy job for the European Central Bank. And, the market's odds are, kind of coin flip between 25 and 50 basis points. But they've got a very challenging environment to deal with as well.
And most importantly, I'm taking John out to dinner to present him with his AARP card because he's turning 50.
We'll have to see what the payroll situation for seniors looks like next week, John.
Happy birthday, big guy. We're very proud that you're still alive.
Thank you. Thank you.
We'll see if he makes it to the next podcast.
Yeah, that's right. All right. Well, thank you so much. I'm feeling older every day.
Well, happy birthday, John. Thank you to everyone who's listening. This is the Macrocast. I'm Ylan Moy with Penta. Again, thanks to John and Brendan from Markets Policy Partners for joining me. Thank you to John Dick from Civic Science as well. Please remember to like and subscribe wherever you listen to your podcast, and feel free to wish John Fagan a happy birthday along with us. Have a great day, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.